Welcome, Henrietta. Great
Good
to have
morning.
you here. So the Fed on pause, and we've seen a little bit of a backup in yields on optimism, perhaps on progress in the US-China trade talks. Is that a trend that continues, a backup in the long end of the 10-year Treasury yield?
I think it's something to watch, and we've seen quite a move in the last few weeks. I think there's a reason for that. Over the last few months, we have seen some positive news on the geopolitical side. I think it actually started in the summer when we had a bit of a resolution in terms of what happened to the Italian government, and less uncertainty there. Then the UK didn't drop out of the EU on the 31st of October. Again, a piece of positive news. And now you've got these good news in terms of trade talks as well between the US and China. So I think it's been building up gradually. So I think a pause at this point from the Fed makes sense, and a bit of a steepening of the curve as well. We'll see if it goes on. I think we need to get a bit more clarity on some of these issues.
Henrietta, good morning. It's Manis from Abu Dhabi. So that steepening of the curve, how steep can she go? And what are the consequences for the term premium? We've touched on it a couple of times over the past 24 hours.
I think there's still room for the term premium to increase. I think it's still pretty low, but we've got a more normal shape in terms of the curve, and we had the inversion over the summer. That's gone away. I think the market is seeing that the Fed has adjusted its policy and is no longer maybe behind the curve. At this point, I think the short end is quite tethered. They are waiting to see what's going to happen. For me, there has been a degree of kicking the can down the road, not a resolution of some of the issues that we're facing at the moment. And the longer end, we'll see how the markets react to that. But if you get a buoyant equity market, which we've had over the last few days, yes, that's going to put pressure on the long end.
How much risk do you want to take in credit then, bearing all this in mind? A Fed on pause, perhaps some more optimistic news out there. Some people even talking about a bottoming in global manufacturing in 2020 looking brighter.
Yes, I think a better environment from an economic perspective is good for credit spreads. We'll have to see what impact it has on the rate market in the case of investment grade, but a better economic environment would definitely be better for the sub-investment grade, your loans, your high yield. I do think there are some issues that are still being worked through. If you look over the course of this year, you look at European single Bs, for instance, you've had a fair amount of dispersion, some idiosyncratic risks, some risks linked to the auto sector, which is still going through a difficult transition. In the case of the US, it's been more on the loan space, and you've had a bit more volatility driven primarily by some of the sector exposures. You've got more exposure on the energy side in the US loan market, and that's coming through. So all of that would be helped by a better economic environment, but I don't think we're quite out of the woods yet.